Oh my god, this is fire. What if this came out of the ceiling? Oh my god. When you install stuff for your Airbnb and then you have to actually safety test things. I'm a little delayed on this. I should have tested this a long time ago. But now that I am, I'm like, yo, this hammock is fire. So I'm about to. I will stop rotating. But I'm about to read. I'm definitely vlogging in this hammock. This hammock is lit, and I hope to God that I installed this properly. Anyway, hopefully I did this well. I'm sure I did. Welcome back to the vlog. This is gonna be a very ADD vlog. You can say I'm on some bullshit, but it is what it is. This is gonna be one of those don't worry about the visual, just listen to the book kind of vlogs, all right? Chapter 12, Trading Systems. Richard Dennis was a commodities trader who became known as the Prince of the Pit. In the early 1970s, he borrowed $1,600 and reportedly turned it into $200 million over the course of 10 years. Mr. Dennis believed that successful trading could be taught and recruited 23 aspiring traders to settle the point with friend and fellow trader William Eckhart. After training the group with a simple trend following trading system for 2 weeks, he gave those that showed the greatest promise $250,000 to $2 million of his own capital to trade. The so-called turtle traders netted a reported $175 million over the next 5 years following this simple trading system, which clearly defined rules for successful performance. Nevertheless, it is equally important to note that no trading system performs consistently forever without being modified to fit the changing market conditions. Mr. Dennis learned this lesson throughout the 1980s when he reportedly lost $50 million between 1987 and 1988 due to the market crash, and again in the late 1990s and 2000s when other market crashes occurred. In this section, we'll take a look at trading systems, how they are developed, and how they can be used to remove emotion from the trading process and therefore improve performance. So what they are: day trading is considered an art by some, a science by some, and a combination of the two by others. In each case, traders develop strategies to capitalize on price action. Then they test, practice, and refine these strategies over years until they become consistently profitable. Those who focus on a scientific approach to day trading often rely on trading systems to maximize that adherence to the rules and minimize the emotions that are commonplace in the market. Those who choose to place discretionary trades rely on their instincts to do so. Trading systems are simple rules or parameters used to determine when to buy or sell securities over time, a security over time. These buying and selling signals are often plotted on a chart in real time to identify potential trades. Automated trading systems will even execute trades on a trader's behalf without him having to lift a finger. These systems help reduce emotional influence in the day trading process. Although the same set of rules won't work forever in every market, traders who prefer following a system are focused on process over profit. Most trading systems are based on interaction between technical indicators, including moving averages and momentum oscillators. By combining two or more of these indicators, day traders can establish a set of rules to determine when a security should be bought or sold. A moving average crossover may produce a buy signal, for example, but only if a momentum oscillator is sloping higher and above a zero line to be valid. These rules can be programmed into a software application to automatically generate signals based on real-time pricing data received from stock exchanges or financial data providers. Advanced trading systems may leverage on other elements that go beyond simple technical indicators. Using pattern recognition algorithms, some trading systems automatically identify chart patterns that can be incorporated into analysis. Others read and interpret order books to determine how unexecuted orders may affect price in the future. And in some case, neural networks and other advanced mathematical models may be used in order to identify patterns that may seem entirely invisible to the human eye. Traders using these systems are always pushing the envelope in order to gain the slightest edge in the market. Many trading systems, especially automated trading systems, include money management rules in order to make position sizing an objective process. For instance, a trader might specify that only 5% of total capital be risked on any single trade with the trailing stop loss point that helps limit risks and locks in profit as the trade plays out. Many trading systems use fixed position sizes, percentage of account value, or specific money management systems like Kelly Criterion or the Larry Williams formula to optimize position sizing. When implemented properly, these systems can help reduce the risk of catastrophe by limiting the risk exposure for any individual trade in the context of a larger portfolio. The success of a trading system depends entirely on its rules, which means that day traders spend a lot of time optimizing trading systems to manage risk and improve various performance metrics. Oftentimes, these changes involve modifying specific parameters used within a rule, such as the number of days used to calculate a moving average. A small change in such parameters could produce significant long-term gains, which means that developing and backtesting strategies can pay off significantly over the long run. Advantages versus disadvantages. There are many advantages but also disadvantages to using trading systems, which are important to consider before developing and or using them. When making the decision, day traders should consider the time that they have to devote to honing a trading system, their level of technical expertise, the starting capital they have to invest in trading, and many other relevant factors. Advantages of trading systems include emotionless. By automating the trading process, trading systems remove cognitive biases and other emotional factors that can prove detrimental to trading performance. In the case of automated trading systems, these factors are removed entirely, and the trader must instead focus on improving his trading system's rules over time. Time saving. The trading systems help traders focus on refining their technique rather than searching for opportunity every day. In many ways, it's like an executive focusing on how to improve a business rather than spending all of the time filling out paperwork merely to stay in business. Outsourceable. The development of a trading system can be outsourced to third-party teams. Outsourcing helps speed up the process by eliminating technical procedures. By doing so, a lot of the complexities in programming are avoided, and more time can be spent refining trading rules and optimizing one's performance. Disadvantages of trading systems include complex. Trading systems are often complex in nature. If the process were simple, everyone would be using trading systems to automate being rich. The development of an effective trading system relies on a deep understanding of technical analysis, while the constantly evolving nature of the markets mean that optimization is always necessary in order to remain profitable over time. Assumptions. Trading systems may appear profitable after backtesting them, but it's important that day traders use the right assumption in order to ensure that their success in the real markets. In order to ensure their success in the real markets, day traders must account for varying amounts of slippage when determining execution prices in backtesting environments, which can be difficult to predict considering the volatile nature of the financial markets. Time consuming. Trading systems may have the time or may save time after they are developed, but creating them in the first place can be very consuming. Day traders must have a firm grasp of technical analysis, which can take a lot of time to acquire. Even so, finding the right combination of technical indicators to produce consistently profitable trading signals is a profoundly difficult process that is constantly in flux. Build versus buy. Trading systems can either be developed or purchased. Well, yeah, okay. There are many advertisements on the internet for trading systems that promise outlandish returns and that can be purchased for less than $500. While these ads are clearly untrue, since such returns would net the owners billions of dollars over a short period of time, there are some decent trading systems that can be purchased off of the shelf instead of starting from scratch. Buying a trading system can help save time and money and would otherwise be spent developing and perfecting such a system. In general, most day traders are probably better off developing their own trading system instead of buying an existing system off the market. The act of building a trading system itself is a learning process that helps day traders learn about the market and hone their skills over time. For each experimenting with the interactions between many different technical indicators may help them get a feel for how they work in different markets. Since they are building the system from scratch, they will also inherently understand all of the trading system's components, making it easier for them to modify these components or expand on them in the future. The black box trading system that can be bought off of the shelves are not always transparent about how they work, thus making it difficult to find and diagnose potential problems. For example, a trading system might consistently generate sell signals before a turnaround occurs, leaving room for improvement by modification. Traders who purchase trading systems off of the shelf may not know the exact rules to the system to follow for exiting a position. Without knowing these rules, it is impossible to modify the trading system to improve the timings of sell signals. Building a trading system. There are two ways to build a trading system: building it from scratch using a program language, or building it using an existing software platform in a meta language. While there are many differences between these approaches, the idea of establishing a set of rules and parameters to automatically identify and perhaps execute trades remains the same. The choice between the two options depends largely on day trader's expertise and the complexity of his trading system upon implementation. Building from scratch. The most basic way to develop a trading system is to develop it using computer programming languages such as Java or Python. Software developers are very familiar with these languages. The new programming, however, will likely have to start from the beginning in order to get a good grasp on the language before they can even begin working on a trading system. The good news is that there are many resources such as books and classes that are designed to help beginner programmers develop the basic skill sets that they would need in order to create these types of systems. Learning these languages can be a challenge, but they provide the greatest level of flexibility when it comes to designating and implementing trading systems. Many professional traders develop trading systems using these techniques so as to benefit from this level of flexibility and gain an edge in the market. The process for developing trading systems from scratch includes initial setup. Day traders must set up a simple development environment where trading systems can be developed, compiled, and run. Oftentimes, these setups may consist of high-performance personal computers and a reliable internet connection. Data handling. Price data can be downloaded for free or from free or paid sources. Sources including financial portals, brokerages, or exchanges, and then imported into the application. Live trading environments require reliable and paid data feeds for obvious reasons. Data analysis. Third-party packages like Panda for Python can be used to simplify the process of crunching numbers and avoid having to write low-level code. Using these tools, traders can focus on what's important without worrying so much about the little things. Building and testing. Day traders must actually build and test trading systems using a combination of data and data analysis libraries. Using historical data, traders can then see how the system would have performed in the past. Integrating. The trading system can be used to generate trading signals that are output to the day traders or directly sent to a brokerage platform as an actual order using an API. Good fuck. All right, let's go back. The trading system can be used to generate trading signals that are output to the day trader or directly sent to a brokerage platform as an actual order using an API in order to place trades automatically without the day trader's intervention. Thank you guys for joining. I will see you next time. Me and Boo are off to bed. Good night.